What's next for markets?
Hi, this is Emily Needell, and for today's podcast, I am joined by Stephen Gregory and Danny Kirsch, who heads up the option strategy and trading team at Piper Sandler.
Danny, thanks so much for joining us today. Every time you come on, you leave us wanting more. So thank you so much. To start off, kind of want to just toss it over to you. What are you talking with people about in markets today?
That is a really nice introduction. Wow, I am flattered. So year end, it's been an interesting year. It's a question we get if we're working at an options desk. It's been a busy year, a good year. And for us, we're having a good year. For our clients, we're having a good year. And it seems like there's been a lot of opportunities and a lot of bespoke catalysts, some of them real, some of them almost fake catalysts. Like you had the Liberation Day and sell off and then the rally when the rug was pulled. And now it seems like we've gotten to the point where the conversations I'm having is this the broadening out of the rally we've been expecting for a while, playing for a grind higher into year end, and then looking for some of the more hated parts of the market to start nibbling on long. A few examples of type of things we're looking at. There's a large put spread collar in the S&P where a large mutual fund is short an S&P 7,000 strike call that expires on December 31st and long, and now it's an out of the money put spread. S&P's at 6,850, 6,900. So one trade we've been pitching and one trade we've been doing a little bit of, and some of us might have in their PA, is buying a 6,950 call, selling two of the 7,000 call and buying the 7,050 call that expires on December 31st. So it's basically saying, I think the S&P is going to grind higher to 7,000 into year end. And I think that's like another 2 or 3%. To grind higher into 7,000 into the strike. We know dealers are long. So if market goes up, dealers are selling stocks to hedge the delta. And when market is lower, they're buying stocks to hedge their delta. So we think it'll act somewhat as a magnet and buying this butterfly to get exposure. And that trade I mentioned costs $5-6. You spend $5 or $6 to make 50. This SPX D31st, 6,950, 7,000, 750 call fly. So these are the type of that's like a grind higher, get to 7,000. You're playing a little bit of darts to make that trade work, but it's certainly something we've been active in, and it's a trade we like. It's a little cute. It's a 10 times payout, so if it works, it's a nice way to end the year. We've been making the joke that you might be on vacation and SPX cash settles, so it could just be covering the hotel room or whatever. Hopefully, that's the dream. And if it expires at 7,000, you paid $6, you make $44, and you get paid cash. And then beyond that, we've been looking at things tied to a lot of the firm work and ties in with the stuff your team has been writing. It ties in with Don and Nancy that the big refunds are coming early next year. Those refunds are more targeted towards higher income, middle class consumers. So people making between 70,000 and up to, I think it's 450. Those were the big refunds are coming. So an area that I know no one likes being long and we very rarely have upside buying is retail names, consumer retail and like XRT, the names within there. And we like the XRT as a long, and we've been writing about the last few weeks into next year on refunds. And I'm sure you'd agree with this. I feel like oftentimes the best thing to be long is the thing that's as long as it's not getting worse. Like the bar's been set so low. So as long as it doesn't get worse, it's probably going to rally. And then I'm looking at XRT. I don't even know what happened, but the stock is up almost looks like over 10% in a week and a half. Basically, it's been ripping since that Fed cut was repriced in when Williams talked, but nothing there's some decent earnings. But again, the bar is so low on these names and they're such crowded shorts that it doesn't take much good news for these type of names to rip. And you're seeing apparel names beat on earnings, and the earnings don't have to even be good. As long as they're not absolutely terrible, these names are going up. And XRT is another one of these ETFs that's still lower than it was in 2021. Significantly, by the way. The stock's 86.51 and the highs are almost 100 5 years ago. And I don't know how much money we've printed since then.
Would you say that's the overall, in terms of sentiment? You're talking about trades that are grinding higher into year end and XRT moving higher. Would you say people are generally more optimistic about next year? I know the S&P 500 is almost back to the all-time highs at this point. I know there was a lot of concern about valuations and whatnot. Would you say that people are more optimistic now than the last time we were at these levels just a few weeks ago?
Yeah, I'd say that we're seeing very little interest in hedging into year end. I think the consensus is moving to grind higher into year end. And I think some of this is the narrative that Nancy and your team have been espousing, and I think the clients are really agreeing that we're about to hit a really sweet spot into next year with a lot of potential positive catalysts. And that's also why I think the Fed cutting next week is so important, because like when that got repriced, that seemed to shift everyone back to animal spirits. Okay, the Fed's behind us. As long as as long as the Fed is cutting that meeting, you've got one cut now before Hassett takes over in May, or whoever he ends up picking. And you just needed that one in the till, it seems like. It seems like the market was waiting for that. And once that came in, it's okay, we can start getting longer and start looking, though, beyond maybe the tech and AI trade, and start looking at some of these more beaten up areas of the market that will absolutely benefit from the tailwinds of the tax plan. Plus, you could have like tariffs either cut or refunds coming too. So it's like these retail names could be back to back really positive news to start the year. And I don't think anyone, especially when volumes are fairly light, which they will be in December, you don't want to be caught off guard being short these names that had been big underperformers all year, where money is being put into people's pockets, right? And at the same time, rates are fairly low. I know 10-year backed up this week, but you're going to get another cut. And it just seems like low volume, volatility coming down, and markets, the broadening out is what people are playing for. It's been working. And I think there's just interest to move a little bit beyond the AI trade. I guess outside of Google, everyone seems like Google right now.
So you talk about that bottom part of the K that we've been discussing as part of our work. It's just been no good news for a large portion of the equity markets for upwards of 2 years now. And really, as you highlighted, can't get any worse. It's not going to shoot the moon, but you do have all of these positive catalysts going into next year, which should help the earnings picture and broaden out that trade that has just been a perennial underperformer for what seems like forever now. You mentioned the Fed. I always love to hear your insights on what the market is pricing in for events.
Yeah, we see a 73 bip implied move for the Fed for the 10th. And we just look at S&P daily options, and you can just back out a one-day implied move. So December 10th is the Fed. We see the S&P pricing at 73 bip. Interestingly, the last 3 meetings, the S&P basically hasn't moved. So it's like we get these like chops during the day, but then the S&P ends up unchanged. So I think that's like that. And then it's a weird month because they pushed back payrolls to the 16th and 18th of December. That's the November payrolls. They skipped October. That's because the government shut down. So you'll have a couple events later on. But realistically, it's like this next week is the last week where there'll be anything meaningful. You also have AVGO earnings. You've got Oracle earnings. You do have some AI stuff going on. But it's Fed cuts. The market is pricing in a hawkish cut. That's how I view if I look at WIRP on Bloomberg, that gives you implied odds of cuts. There's 1.8 cuts priced between now and April. And the reason April matters is that'll be Powell's last FOMC, assuming he doesn't step down earlier. And that's when you get the new Fed head starting it for May. So basically the market is saying this is going to be a hawkish cut. They're going to cut now, and then they're probably going to hang tight for a little bit. Maybe you get one more cut before Powell leaves, unclear. So that's why I just think as long as they cut, the market's already priced at hawkish cut. It's not like they're not raising rates in the next 3 months. If they do that, I think we're in the all clear into year end. And I like this, like the grind higher 7,000 trade. One thing that we like to pitch, and I know you guys have done some great work on this, is not this week, not next week, but the week after, you start looking at buying calls on some of the worst performing S&P names. And those are names that have been sold for tax loss purposes. And some of these are really good names. They're just people, I don't want to pay there's been a lot of winners, a lot of capital gains, and you offset that with your losers, and those names have been sold. And what we've done and the work that we've done shows that these names do tend to outperform between December and January. So we'll do is buy the 25 worst performing names in the S&P in late December, and you sell them around late Jan. It's like a biggest losers trade. And it sounds fairly idiotic, but it doesn't matter. These trades tend to work.
So there still is time as far as when that tax loss selling happens. You would say basically by mid-December, or practically you've already seen.
Yeah, mid-December is we start putting it on. Is when I'm sure there's stuff that's already rallied that's gotten killed this year. Certainly, we've seen some like the restaurant stocks. I don't know if you've looked at those. They've been absolutely obliterated this year. Like some of these charts are hideous, but they bounced off their lows. And again, this seemed to all coalesce around when that rate cut for December was put in. But I think those names are interesting. Like the There's no one likes these names. No one's long these names. And if anything, people are just very short. And those are the areas that we really like, where it's like you don't need like an incredible news. You just need not worse news. And not worse news, you can get huge rallies.
And don't you always say that market holidays make for good markets too?
Oh yeah, we talked about this. I feel like we did something in July or November. And to be fair, in November the S&P was up. It was a volatile month, but it was up, and a lot of that rally came the week of Thanksgiving. And one thing that we talk a lot about is this idea of delta decay. And again, that's if you own, and it works best when volatility is really elevated. Right now, I'd say it's somewhat high and coming lower, but it's certainly not high. But what happens is when volatility is high, and out of the money put will have a higher delta than it otherwise would when volatility is low. So if you are short an out of the money high volatility put, you have to hedge it on a higher delta. And as that volatility shrinks, you're covering your short stock that you use to hedge, and that can help create a rally. So when volatility is high, that tends to be can be a very bullish setup. And you also get this delta decay dynamic around holidays, and that's what we're about to hit. This year's unique because you have Christmas and New Year's on Thursdays, so I almost feel like it's 3 weeks they're blowing up with nothing happening. And that delta decay dynamic, that every day passing your 25 delta put for January, where the market doesn't move, you lose a holiday, that delta goes to 23, that delta goes to 22, and the dealer who's short stock will be covering, and you get this nice rally into year end. And again, this also ties into this biggest losers trade, because it's certainly true for single stocks as well, especially underperforming names that tend to have higher volatility. When you get all these holidays, it can be a very bullish setup, especially for higher volatility names, but there's no catalyst. If there's no news is good news when volatility is high and when there's holidays. That just means the volume that is trading will probably be buying, and it's the people who are short puts who are recovering that short stock, and you get a nice lift. And I think that's part of the reason why this end of year grind higher seems to us like a pretty likely, no, I don't want to say likely, it seems like a fairly likely outcome, notwithstanding some exogenous shock that we didn't expect. There is always chances for negative news. There's always chances for negative surprises. All else being equal, we think we just grind higher in the year.
So the setup is for potentially good backdrop heading into the end of the year.
I think so. I mean, I think you want to be long though. I like financials. We bought some industrials upside. I think I like buying like retail. Financials are interesting because next week you also have mid-quarter updates for the large banks. I guess they just give some guidance on what their earnings look like, how things are going so far in this quarter, and that's the large financials. So names like Citi, Morgan Stanley, Goldman. So again, that's another area where we've been nibbling on upside. And a lot of these ETFs, they're not at their highs, but they're sitting right near their highs, and it looks like they're all ready just to break out, like in a technical bath. These are things that all look like they're ready to go. And I feel like you're going to get these mid-quarter updates in the banks, plus the Fed cutting. Maybe we get a nice like couple percent rally next week, and then can coast into the new year. And
what about within tech? Are you seeing a lot of, as far as AI names and the trades that people are putting on options wise? What are you seeing there?
a little, so on the hedging front, puts on Oracle and Palantir constantly. That's be the two names that people want to fade as far as the AI trade and over levered or whatever is, or maybe too frothy. Those are the names that people seem to be fading constantly. On the upside, robot names, everyone seems to be buying or getting squeezed. And I saw iRobot's been up like 50% the last 2 days because the Trump administration made a comment. They want to incentivize robot building. I'm sure you've seen Tesla's been absolutely ripping because that's the other robot name. You've had the eVTOL, like the robo helicopter things. Those have been going. It's a little meme-ish right now. And then this week we did have people buying Amazon upside, which hasn't really worked around. They had an AWS event where they also announced the launch of their Trainium 3 chip, but to much less fanfare than Google got when they had all the news on their TPUs last week. Amongst the Mag 7, we've seen Amazon upside. It's been a laggard all year. It hasn't really worked yet. Certainly robot upside, and then on the downside, Oracle, Palantir. Those are like perma put buys for people. Those are the two names that people are targeting. And NVIDIA seems a little more mixed. One other thing we've been doing, I think it's an interesting trade, TSM, upside for next week around AVGO and Oracle earnings. So both those names report. Oracle reports on the 10th, AVGO on the 11th. TSM is a supplier to AVGO, and I think to a lesser extent Oracle as well. Anyway, if they have good earnings, TSM we'd expect to rally, so we like calls for that for next week. It's like a bank shot trade.
So you're talking about robotics and these mega cap names. One of the things you've heard bubble for a while now around the AI trade. When you're talking to investors, I'd love to hear your thoughts on AI bubble because I feel like that chorus has been rising lately.
Have you heard this thing that someone said a bubble is just something going up that I'm not long?
Yep.
You ever heard that?
Junk is all the stocks I don't own.
That are doing well. Yeah.
And that's fair too. I think people say bubble, but it's tricky, right? It seems like they're picking their spots. I don't think anyone thinks Google's in a bubble. I think they think some of the spending is. And again, I think that's why names like an Oracle or other people are comfortably shorting because they have a lot more debt. And that's where like you can actually get ran over. Whereas a name like Google generates a ton of free cash flow. Can really pretty much self-fund. And when need be, turn off the spigot here and there. There are certainly bubbly areas. Like we have a frothy indices sort of screen that we keep an eye on. And that's areas like quantum. People kind of mess around on the long or short side, but it's almost like a momentum trade. Like when those things, they need to drop 10% for people to start buying puts. Like they don't want to, no one's trying to call tops. Nuclear is another area. And like those are the areas where we see people will tactically buy short dated puts. But the only like really structural shorts have been, again, like an Oracle, and then also names like MSTR, like the Bitcoin stuff, like the DATS, the digital asset trust. I think people are very comfortable being short, and either they'll be long Bitcoin against it, or they'll be long like a Qs against it. It's playing a higher beta short that has a lot of fundamental reasons it could underperform.
Going back to the end of this year, that part of the conversation, any thoughts on the potential tariff court case announcements that Andy was saying we're a month out from oral arguments? We're now in the window where you could start getting something from the justices on that, on IEPA. Anybody concerned about that? You concerned about that? Market pricing anything on that?
So I don't know, like it seems like the only way to trade this. So I think there's two trades. I don't know if there's concern about it, but I think part of this is some of this retail rally where these names would actually be winners because they get money back and potentially lower tariffs on a go-forward basis. Costco, I think there was news that they're going to the lawsuit to try to recoup some money if these tariffs are deemed illegal. And then the other area, I do puts on TLT. So TLT is like long treasuries. It's long like it's 22-year duration. So it's like basically long a 30-year bond. So when TLT goes up, when rates go lower and vice versa. So if rates are going higher, TLT selling off. So one trade that we've been pitching around exactly what you're talking about is buying puts on TLT into next year. If the tariffs are deemed illegal, with these huge refunds coming back via the big, beautiful bill, with the uncertainty around the Fed and who's running it, and if the tariffs are deemed illegal and the money has to be sent back and the tariff collections have already been light, the conversation about the deficit is going to reemerge. And then that narrative will people will talk about this is out of control, and you might see some selling pressure on the 10-year or the long end of the curve. And that's where I think this plays out is higher long-term rates because the deficit looks so bad if the money has to be sent back. For what it's worth, interest rate volatility is the lowest I've ever seen it. So there's absolutely nothing priced. So again, if you want to buy a put on TLT, we think that's probably the right trade. I'd rather go out to March or in April though, because that's when also you'll have all this money coming back to people via tax refunds around the big, beautiful bill. And you might start to see a temporary pop in inflation as people get money with this high propensity to spend. Again, it's all ties in with like why we like retail names. People will spend money, but if you have money to spend, perhaps that pushes price, that shows up in CPI. Okay, now actually inflation might be a concern again.
And that threatens the whole broadening out, lower rates, broadening
exactly.
out.
Exactly. So TLT it puts is a nice hedge on all of this potentially happening. And you could also win just on growth looking good. We could just have really good growth, which again, when you have larger growth, you might just have a larger interest rate environment or a higher interest rate environment in the long end, which is fine. And this is exactly what happened. I believe, I got to double check. I believe it was 2019 into 2020 where you had Russell rally and the 10-year sell off. You had 10-year rates going up and the Russell rallying for 7 months. And that might be a scenario where we're in also. But in that scenario, great. You're still making money in your TLT puts. I just don't think the long end's going down a lot between now and the middle of next year. Unless there's some catalyst I'm totally missing, the deficit's not going to get better. Inflation might come in, but I think real growth will still look great. And unless you really see employment getting much, much worse from here, which it sounds like we don't, it could get worse, but it more muddle. not much worse. Is that kind of what you guys are seeing? Is that, I know Nancy said if unemployment could get up to 5%, but might not. And with all the CapEx spend, it seems perhaps a little bit unlikely.
Yeah, we're also talking about employment continuing to soften, but at a slow pace, which matters a lot. The people keep asking us, what is the rate on unemployment that would scare you? That could be really problematic for markets. And we like to say that it really depends how fast you get there. If we see a slow and steady rise in the unemployment rate, that's very different than seeing a sharp rise. And so we're not expecting that unemployment is going to be super problematic. And also in terms of what you were saying earlier about if the long rates do stay flat or rise a little bit, we've been looking a lot more recently into how much money is in, talking about consumers in home equity loans, and which are tied to the prime rate and the Fed funds rate. So if we do see the Fed cutting, but the long rate stays flat or even moves a little higher, there's a ton, trillions and trillions of money that could be pulled out from home equity loans because prices are up so much that there's a lot of money that consumers could tap into if those rates come down. a little bit
Home
more.
equity loans are tied to Fed funds?
Prime rate, yep.
Oh, wow. I didn't know that. Oh, so that'd be massive. If you get 50 bips, 75 bips more rate cuts, people will certainly take out money.
It makes a big difference. And so there is, given what's been going on with home prices over the last couple of years, we're at these enormous levels of home equity that's available to consumers if they're feeling good enough to take it out, if rates are low enough that they feel good about it.
It certainly ties in with what Peter Keith has been writing about as well, where he a lot of the furniture names. Because if you're not going to move, maybe you remodel your house,
Yep.
or at least get a new couch.
Could be a great setup.
Yeah. I mean, we've been adding names like FND, Wayfair, Home, HD, Lowe's into next year as well, and those also fit that biggest losers basket. Because a lot of them have been underperformers this year, where you might see money reallocated there into next year.
And they would be the backbone of a broadening out.
Yeah, furniture.
I love it, Danny. Thank you so much for your time today and your insights.
Hey, thanks for having me. Let's do it again soon.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.